Our next panel is on adapting insurance products for pandemic risk. It's moderated by Panos Farangis. Panos leads the Agriculture Finance and Disaster Risk Finance global practice at IFC. Over to you, Panos.
I need my panelists. Okay, they are coming, but let me make a brief statement before we start. I think we talked a lot about insurance in the previous panel, and Priya has set very nicely the stage for us of what we will be discussing in this panel. And we have quite a bit of an experience in financing catastrophic risks and disaster risk finance, and there are definitely a lot of parallels between pandemic as a disaster and natural disasters like earthquakes, floods, droughts, but also some important differences. I think one important difference is that on the pandemics, you have a spillover effect in other countries because the disease can spread that you don't have that with the natural disasters like an earthquake. Maybe with flood, we can draw some parallels. So insurance, as before it was mentioned, is one of the solutions that is being explored. The question is that given the significant externalities of pandemics, what is the true premium of insurance? How do you determine this? And who pays for that? There is also the other issue that we have seen in several countries where there is a lot of interest about insurance following the happening of a natural catastrophe like the Hurricane Mitch in Nicaragua in the late 90s. But then 2 or 3 years later, they did not have a bad hurricane. Nobody again speaks about insurance and nobody is willing to pay any premiums about. So we have a distinguished panel of people from the World Bank, 2 of my colleagues, and also other people from the industry. So we have Olivia Mahul, which is the program manager of the disaster risk financing and insurance at the World Bank. Next to him is Nihilda Victoria Lobo. He's the head of global partnerships in Americas from Swiss Re. Next to him is Jose Angel Villalobos, and he's a senior insurance specialist at the World Bank. And next to him is Simon Young, the CEO of the Caribbean Risk Management Ltd. And we have by video Gunther Kraut from Financial Solutions in live from Munich Re. We will follow a similar format where I'm going to be asking 2 questions per panelist, and then I will ask them to spend in total about 7 minutes, so about 3 minutes per question. So I will start with Olivier, not because he's my colleague, but because also I would like him to help us set up the stage. And Olivier has done a lot of work on disaster risk finance, where he's a big advocate of having a plan, an ex-ante plan for financing, so we don't wait until the happening of an event and then we scramble to find money. So Olivier has done quite a bit of work in several countries where he has set up, helped governments set up this type of financing plans where insurance is one of the instruments. And I would like first for Olivier to discuss this. How do you go about convincing governments, connecting the dots with the public sector and putting the design of such plans, and what are the differences and similarities with his work on disaster risk finance? And then when you have to decide on an insurance instrument, how do you go about? Is it insurance? Is it capital market like cat bonds, like others? Like, how do you decide what is a good mix of that? So that's my first question, Olivier.
Thank you, Panos. When I got this invitation, I was a bit hesitant to come because definitely pandemics and human health is definitely not my expertise. I'm coming with a background on disaster risk financing. However, in my kind of farmer life, working in the Ministry of Agriculture in France, as an economist, I used to deal with some animal epidemics. So trying to combine both, hopefully I'll come with some interesting comments here. Listening to the previous panel on speakers, we can definitely draw some interesting parallel between the work ongoing on disaster risk financing and the work on epidemics. And of course, when it comes to epidemics and pandemics, I would say the challenge is even bigger. But anyway, let me try to draw some parallel and maybe some lessons learned, because we've been now working on that topic. Meaning the community, not only the World Bank, the international community, for more than a decade on disaster risk financing. The dialogue we're having is really with Minister of Finance, and I heard this morning a couple of our speakers also mentioning Minister of Finance. So when it comes to financing, definitely this will be, at least from the bank perspective, our main interlocutor. So the sooner we bring them on board, the better it is. So this is one of the big lessons we learned from disaster risk financing. Now, let me just quickly articulate my points over 4 key, I would say pillars, what we tend to call our operational framework when it comes to disaster risk financing. And again, you will see clearly the parallel with what we're talking here. The first one is about risk assessment. So we're spending more and more time to try to quantify, from a financial perspective, the impact of a disaster. So it's true for earthquake, for floods, that I think this will be exactly the same problem when it comes to pandemics, with, of course, the additional challenge that we're talking about not only direct impact, but also indirect impact. And again, this morning, one of the speakers made a comment about the impact on tourism. So again, any indirect impact will have to be carefully considered. So having some tools to help ministers of finance, particularly to quantify the fiscal, direct and indirect economic impact of a disaster, is definitely fundamental, because they deal with numbers. They don't deal with people directly, they don't deal with some technical information, they deal with budget numbers. So if you can, again, explain that in terms of fiscal impact, budget impact, economic impact, this will definitely help a discussion with the Minister of Finance and ultimately help them take decisions, informed decisions. The second point is to secure funding. Not only short-term funding, and we've been talking a lot about short-term funding here, but also longer-term funding. And again, there was also this parallel this morning, which is particularly true for disasters, but also, of course, in case of pandemics. So you want to make sure that when you need money will be available, and you want this money to be available at the cheapest rate. So how can you secure some sort of strategy, again, to make sure that money will be available, not too much, not too little, and of course to be used efficiently. And this is really the role of the Minister of Finance to think of that. The third important pillar is about budget execution. Again, we talked a lot about that this morning, and we can definitely draw a parallel with natural disasters. We have in mind, and at least I have in mind, many examples where money was available within the Ministry of Finance but could not be disbursed for many reasons, including procurement process. So again, this issue of being able to make sure that the funds will reach the ultimate beneficiaries on time is quite critical. And again, this is even more important in the case of pandemics, in the case of epidemics. And there are many ways to do it. I know that in the Caribbean, for example, and maybe later on Simon can elaborate on that, the Caribbean countries work together to make sure that when a disaster strikes, they can use some service providers together and then make sure that they can come to the country quickly. I do remember working after the Tohoku earthquake in Japan, being very impressed on how quickly the government was able to mobilize service providers to rebuild roads, bridges, and highways. Again, because this was planned in advance and everything was done in advance of a potential disaster. So I would say budget execution and ex-ante planning is quite critical. The last point I would like to make, which goes beyond financing, it's all about the broader disaster risk management and climate change agenda, but again, with a nice parallel with what we're talking here, is also to use this kind of financing mechanisms to create incentives for the ministers of finance to engage on this dialogue. And let me give you one example on disaster risk financing particularly. There was recently an operation in Sri Lanka where the government of Sri Lanka took a line of credit with the World Bank, particularly for disasters. So money will be readily available when a disaster strikes, contingent upon the declaration of a disaster. And at the same time, the team at the World Bank worked with the Ministry of Finance and the line ministries to have investments in risk mitigation. So we ended up with this very nice package where the Ministry of Finance had something to have, which is this line of credit, and at the same time was also willing to invest some of their scarce resources in risk mitigation. So we use really financial mechanisms as a way to engage, but also to incentivize the ultimate decision makers, Ministry of Finance, really to invest in risk mitigation. Now, a couple of more comments, and again, lessons learned, just to finish on this first question. The key issue also we see, particularly when it comes to, I would say, ex-ante financing, to make sure that funds will be made available readily after disaster, is the strategy behind that. So one of the lessons we learned a lot, it's not an issue of a product. insurance versus bond versus promissory notes. It's really a combination of products. So a lot of work we're doing is really to combine those products, and they're not mutually exclusive, quite the contrary. Insurance, as we know, work pretty well for, I would say, extreme events, while reserves may be more adequate for recurrent events. So the question is, again, is how you're going to combine those instruments to make the funds available when they need to be made available. And what we learned also a lot from disaster risk financing is that a bottom-up approach sometimes makes a lot of sense. When you talk with ministers of finance in countries, of course they're concerned about extreme events, but they're also even more concerned by recurrent events. So again, in the case of disaster, this will be flood versus earthquake. So the first question will be for them to make sure that if tomorrow a flood occurs, they will have funds to finance that before they talk about the 1 in 100-year earthquake event. So this kind of bottom-up approach is also quite efficient. Again, to build their capacity and to make sure that you can respond to their immediate needs before you think about extreme events. And again, I will also draw a parallel with pandemics. Again, discussion could be, of course, about extreme events, but also what about the more recurrent events, which ultimately could also cause significant fiscal burden on the government. So these are the combinations that have to be considered. Interesting parallel, I will stop here. But again, we can see a lot of interesting parallel between, again, disaster risk financing and pandemic financing.
Let me have a second question, but a little bit shorter. The second question is about how would a government or a country determine the cost-benefit analysis of paying for an insurance premium when, in this case, you have a lot of externalities, like in the pandemics?
So I'll try to be brief here. First of all, let me try to qualify what we mean by cost of insurance. From our experience, we see two main costs. First of all, the financial cost. You need to pay for the premium. But usually it is not the most important cost. The political cost, sometimes even bigger, where a government may pay for a premium. You may not face a disaster for the next 2 years, luckily for you. And then at some point, the government will have to explain to their parliament that they have to pay for a premium and there was nothing in return. So how you manage this kind of political concern? And I could go beyond that, where by definition, when you talk about insurance, you have some exclusions. Insurance will not cover everything. So you may have a payout, but the payouts to some extent may be smaller than what you would have expected, or may come later. So all these kind of political, I would say, costs have to be carefully thought. And many governments, I can say, tend to be a bit reluctant to buy insurance, not less for the cost of itself, but also for the political burden that would generate in the longer term. Now, again, you can overcome that, and some countries, including Mexico and other countries, have done some very interesting work trying to balance and optimize this kind of financial products, using insurance, using other more sophisticated product, cat bonds, reserves. The question again is to help the governments try to take into account not only the direct costs, but also in the case of pandemics, this will be the indirect costs. And how you draw the line is, of course, a very technical question. And again, for pandemics, I will not try to do that. But again, for pandemics, even more difficult because we're talking about lives. So how you're going to monetize that is also a kind of a key question. But ultimately, the cost-benefit analysis will have to combine instruments, not try to oppose instruments. And an optimal risk, what we call risk layering approach, trying to identify the right instrument for the right type of risk, whether it's frequent or infrequent, is also an interesting question. So at the end of the day, the Ministry of Finance will have to deal with insurers because they offer insurance solutions. They may have to deal with banks because they may offer some lines of credit. So it's not one single partner to deal with. It will be a combination of partners because they may offer slightly different solutions to answer their questions.